We always like digging into the latest happenings in finance.
Mm.
And today we're really diving deep into this news circular. It's from, you guessed it, India's financial watchdog SEBI. That's the Securities and Exchange Board of India, by the way.
Right. And they're shaking things up this time with equity index derivatives.
Definitely a lot to unpack there.
Yeah.
I've been going through these new rules, and it's really interesting to me how SEBI is using these to kind of reshape how everything looks when it comes to risk management.
Totally. It's like they're looking at how the whole system works and saying, okay, how do we make sure everyone's playing fair and keeping investors safe?
Yeah, absolutely. So let's break this down because there are 6 big changes we got to talk about. 6. First up is this whole thing about upfront payment for option premiums. So no more saying I'll pay you later when you buy options.
It's like you got to put your money where your mouth is. Think about it. If you could buy a risky option, but only pay a tiny bit upfront. Tempting to take bigger risks than you can handle, right?
Makes sense, yeah. So SEBI's saying, look, if you're going to play in this market, you got to be able to back it up.
Exactly. It helps prevent people from getting in over their heads, make sure everyone's playing at a level they can actually afford.
Interesting. Like raising the bar to make sure everyone's trading responsibly?
Yep.
Okay, so this next change, it feels like a direct response to, those crazy moments when everyone's watching the clock on expiry day. It's all about how calendar spreads are treated.
Expiry day is definitely when things can get a little wild, right? And SEBI's noticed people using calendar spreads to, well, kind of take advantage of that craziness.
I'll be honest, calendar spreads sounds pretty technical for someone who's not a derivatives expert. Can you explain that one?
Sure. Imagine you've got 2 option contracts, one ending this week, one ending next week. A calendar spread lets you balance out potential losses on one with potential gains on the other.
So it's a way to manage your risk over different time periods. Gotcha. But what's the issue with that, specifically on expiry day?
Well, on a day when prices are bouncing all over the place, SEBI's worried that using calendar spreads to offset positions could actually make the volatility worse, not better.
Oh, wow. I didn't think of it that way.
Yeah, it's almost like, trying to put out a fire with gasoline. It's not going to end well.
So they're trying to prevent people from accidentally making things worse, especially on a day that's already a bit chaotic.
Exactly. Manage the risk, both for the individual trader and for the entire market.
Definitely seeing a theme here. SEBI's all about stability, all about managing risk.
Absolutely. And that leads us right into the next big change, keeping an eye on position limits throughout the trading day.
Okay, that sounds kind of intense. Like, is Big Brother watching every single trade now?
Think of it this way. Right now, those position limits, they tell you the maximum you can hold, right?
Right.
They're usually checked at the end of the trading day.
Makes sense.
But with how fast and high volume trading is these days, especially on, you guessed it, expiry day, someone could theoretically go way past those limits without anyone knowing until the day is over.
Oh, I see. Kind of like you don't know you've overspent on your credit card until you get that over limit fee.
Right, exactly. So SEBI is proposing intraday monitoring, basically checking in on traders' positions at random times throughout the day.
So it's like those speed cameras on the highway.
Mm-hmm.
You might get away with speeding if there's no camera, but just the possibility makes you think twice, right?
Precisely. And if you do go over those limits during the day, the penalty's the same as if you hit it at the end of the day. Fairness and transparency all around.
Makes sense. It seems like they're really tightening things up with this change, making it clear they're serious about keeping things orderly.
And we're just getting started. We've got 3 more major changes to unpack here, each one designed to, really reshape how the derivatives market works in India.
All right, well, let's get into it then.
Let's do it.
It's kind of wild how these changes might seem small on paper, but they can really shake things up in the market.
It's all about the details, right? Like understanding how even tiny adjustments can have a ripple effect. And speaking of adjustments, have you seen what they're doing with contract sizes? SEBI's bumping up the minimum contract value for index derivatives.
Oh, yeah, I saw that. Why do you think they're doing that? Is it about trying to get bigger players into the market?
I don't think it's necessarily about attracting bigger players, but more about keeping things relevant. See, the current minimum value, it was set back in 2015.
And a lot has changed since then.
Exactly. The market's grown a ton. The Sensex and Nifty have been, well, on a tear, really.
They really have.
Since 2015, the market cap of those indices has more than tripled.
Wow, triple.
So to keep up with that growth, to make sure the derivatives market actually reflects what's happening in the cash market, SEBI's raising that minimum contract value. For new contracts, it'll be Rs 15 lakhs.
Okay, so it's about keeping things proportional. Makes sense. But what does that mean for traders, especially anyone used to working with those smaller contracts?
That's a great question. It might mean rethinking some trading strategies, maybe figuring out different ways to use their capital. Could be an opportunity to really look at their risk tolerance too, Decide if they're comfortable playing at this new level.
It's like SEBI is saying, okay, playtime's over. Time to step up to the big leagues.
Aha, love that analogy. And it really gets at this idea of protecting investors, right? When you're dealing with bigger sums, it kind of creates a natural barrier. It weeds out anyone who might not be ready for that level of risk.
Fascinating how these changes are, like rewriting the rules of the game. All right, so next up, we've got a change that's directly tackling that excessive speculation you mentioned before, rationalizing weekly index derivatives.
Right, so you've probably heard of high-frequency trading, yeah.
Definitely.
Well, in the world of these weekly index derivatives, it's not unusual for folks to be in and out of positions super fast, sometimes just minutes.
So they're riding those tiny minute-by-minute price swings, trying to make a quick buck.
Exactly. And while that kind of trading can make the market more liquid, it can also make it way more volatile. It's a roller coaster, and a lot of investors, especially your everyday retail investor, they could get burned.
So what's the solution? Ban weekly index derivatives altogether.
Well, they're not going that far. Instead of a total ban, they're taking a more targeted approach. From now on, each exchange can only offer weekly derivative contracts for one benchmark index.
So instead of having a whole bunch of weekly contracts, each exchange picks their flagship index to focus on.
You got it. It's all about finding that balance, right? SEBI gets that these weekly derivatives are useful. They give traders options, literally, but they got to keep that speculation in check.
Always that balancing act. Encouraging innovation, but keeping things stable.
Exactly. Which brings us to our last big change. This one takes us back to risk management, boosting the tail risk coverage on when else, option expiry day.
Okay, gotta be honest. Tail risk sounds a little intimidating. Break it down for us. What is that?
Haha, sure. Imagine you're trying to predict what's going to happen, like how a stock price is going to move. Most of the time, those outcomes are going to fall within a pretty predictable range. But there's always a chance, a small chance of something totally unexpected happening, right? Something that throws everything off and makes the price go haywire.
So tail risk is about planning for those, black swan events, those rare but potentially disastrous things no one sees coming.
Bingo! And to reduce those risks, especially on, you guessed it, expiry day, SEBI is increasing the tail risk coverage needed for short option contracts.
More protection against those market-shaking surprises.
Exactly. How we're doing it is by increasing the extreme loss margin, or ELM. It's basically a safety net for potential losses if things go really south. By tacking on an extra 2% ELM just for short option contracts that expire on expiry day, they're adding an extra layer of security for both individual traders and the market as a whole.
So every change we've talked about today, it all comes back to managing risk. SEBI's not messing around.
Not at all. They're not just sitting back and watching. They're actively shaping a stronger, more resilient derivatives market.
Building a solid foundation for the future of finance in India.
Couldn't have said it better myself. It's all about finding that sweet spot between encouraging innovation and keeping things safe. It's tricky, but SEBI seems up for the challenge.
It's easy to get lost in all the technical stuff with these kinds of changes, but I really appreciate how you've helped us see the bigger picture, like how these adjustments actually play out in the real world.
It's all about understanding the why, right? These aren't just random rules. They're directly addressing what's happening in the market.
Exactly. So let's bring it all home for our listeners. If someone's out there listening to us, maybe they're trading in the Indian derivatives market right now, what's the one big thing they should take away from all of this?
One word: adapt. This market, it's always changing, always evolving. And these changes are a perfect example. SEBI's making it clear they're shaping this market, pushing it towards more stability, more transparency. The traders who can roll with the punches, the ones who see these changes coming and adjust their strategies, they're the ones who'll succeed.
So it's not just about knowing the new rules. It's about understanding what's driving those rules and being ready for whatever comes next.
Exactly. Be proactive, not reactive. Stay informed, ask questions, and don't be afraid to adjust your risk tolerance. Adjust your strategies as the market changes, because it will.
It's like being a sailor, right?
Yeah.
You got to adjust your sails to the wind if you want to get where you're going.
Love that. Perfect analogy. And in this case, SEBI is kind of like the navigator, helping to guide everyone towards a safer, more stable journey.
This has been a fascinating deep dive. Really appreciate your insights on this.
Anytime. Always happy to geek out about market dynamics.
But, as always, we want to leave our listeners with something to chew on, something to think about.
Gotta love a good open-ended question, right? What do we have today?
Well, we've talked a lot about SEBI trying to find that balance, encouraging innovation, but also managing risk. But what if there are some unintended consequences here? Could these rules, even though they're meant to be good, could they accidentally limit who can participate in the market or stifle certain trading strategies in ways SEBI hasn't foreseen?
Now, that's a really interesting question, and I'm sure it's one that'll be debated for a while.
Definitely. And as those debates play out, we encourage everyone listening, stay engaged, stay curious, and most importantly, stay adaptable. Until next time, happy investing, everyone.
To smarter and safer investing.